Look, quick question. Have you ever looked at a stock chart and thought, how did people lose that much money in a company everyone believed in? Because here's the scary part about the stock market. The biggest losers usually don't look dangerous in the beginning. They look safe, popular, long-term investments. And today, we're talking about 5 S&P 500 stocks that absolutely crushed investors over the last few years. And more importantly, why they failed. Because if you understand the pattern behind bad stocks, you'll avoid mistakes that destroy portfolios for decades. My name is Henry, and I spend way too much time thinking about why people lose money in the stock market without realizing the risks they're taking. If you want to build wealth intelligently, not emotionally, hit subscribe, because this is exactly what we talk about here. Let's start with number 5. Number 5, Charter Communications. At one point, this looked like a money printing machine. Millions of cable customers, internet subscriptions, recurring revenue. Sounds perfect, right? Except here's what most investors ignored. The business was slowly dying. Streaming services destroyed cable TV, competition increased, and the company carried massive debt. So even though the stock once looked stable, it became a trap. And this is your first lesson. A company can have strong revenue and still be a terrible investment if the future is getting worse. Number 4, Lululemon. Now this one surprises people, because Lululemon is still a strong brand. People love the products. The stores are packed. So why did the stock collapse? Simple. The expectations became insane. This is something beginner investors never understand. A great company does not always mean a great stock. If investors expect perfection, even small disappointments can destroy the share price. Growth slowed slightly. Consumers started spending less, and suddenly, the market panicked. The stock dropped hard. Because in the stock market, price matters just as much as quality. Number 3, Trade Desk. Now we get into the dangerous world of hype. Trade Desk exploded during the digital advertising boom, and for a while, people treated it like the future of advertising itself. But here's what happens with high-growth stocks. When interest rates rise, the market becomes brutal. Investors stop caring about future potential. They want profits now, and stocks that were trading at ridiculous valuations suddenly crashed, some by 50%, 60%, even 70%. This is why hype is dangerous, because when expectations are unrealistic, reality becomes expensive. Number 2, Intel. This one is honestly painful, because Intel used to dominate the semiconductor industry. They were the giant, but while the world changed, Intel moved too slowly. Meanwhile, competitors like AMD and Nvidia kept innovating faster. And here's the lesson. Most people miss. Big companies don't stay big automatically. Markets evolve. Technology changes. Leadership disappears. And investors who assumed Intel was too big to fail learned something very important. Stocks are not loyalty programs. The market doesn't reward nostalgia. Number 1, PayPal. This is the one that trapped millions of regular investors, because during the pandemic, PayPal looked unstoppable. Online payments were exploding. E-commerce was booming. The stock went insane, and people convinced themselves this is the future. But then reality hit. Growth slowed. Competition exploded. Margins weakened. And the stock collapsed more than 70% from its highs. Now here's the scary part. Most people bought near the top, not because they understood the business, but because they saw the stock going up. And this is the biggest investing trap of all. People confuse popularity with safety. The more a stock rises, the safer it feels, even when the risk is actually increasing. So here's the real takeaway. Bad stocks usually don't look dangerous at first. They look exciting, popular, innovative, safe. But behind almost every stock disaster, you'll usually find one of these problems. Too much hype, unrealistic expectations, slowing growth, massive debt, or a business model that's quietly dying. And if you learn to recognize those patterns early, you avoid catastrophic mistakes. Because investing isn't just about finding winners, it's about avoiding disasters. If this video helped you think about stocks differently, hit like and subscribe. I break this stuff down every week in a way that actually makes sense. And yeah, sometimes the best investment decision is knowing what not to buy.